Hello, Professor. Hello, class. My name is Vincent, and this presentation is in partial submission of the requirements for Accounting 429 Federal Income Taxation. Today, my team and I are presenting the second part of our tax research project that addresses Section 199A deductions. You will have the pleasure of hearing from Kim Haskins, Kaitlyn Jones, Lauren Meeks, Kaylee Otto, as well as myself as we break down a hypothetical situation provided to us, as well as provide an analysis and a suggested plan of action for the said scenario. Well, without further ado, here's Lauren with the presentation outline.
Hello, Lauren Meeks here. Our presentation will follow the provided format as outlined below. The issue we will be addressing is how does the new Section 199A deductions apply to our hypothetical client, Thomas Drake, in a situation as well as what is the allowable deduction, if any, and concluded with tax planning strategies to consider. Vincent will begin with breaking down the scenario provided, then followed by Kaitlyn, who will introduce what a Section 199A deduction is and explain what is a QBI or a qualified business income. Kaitlyn will be followed by Kim Haskins, who will explain what a SSTB, which is also known as a specified service trade or business, as well as introduce how to calculate a Section 199A deduction. In addition, Kim and Kaylee will continue to explain the income thresholds associated with the Section 199A deduction. Vincent will continue to explain how this deduction applies to our client. After Vincent, I will pick up from there to explain how we computed to the allowable deduction and provide with the first planning strategy for Thomas Drake. Kaylee and Vincent will then proceed to conclude the presentation, providing other tax planning strategies to consider. I hope you all enjoyed the presentation.
Thanks, Lauren. Vincent here again. Let's begin and review our given scenario, starting with the facts about Thomas Drake. Thomas Drake is a small business owner with a manufacturing plant located in Chicago, Illinois. He has formalized his business structure as an S corporation. An S corporation is a pass-through entity. This means that in most cases, the business entity itself will not be liable to pay taxes. Instead, the liability or benefit is passed through to shareholders, otherwise known as its members. As stated, S-corps are generally not taxed unless the S-corp has tax on built-in gains, an excess net passive income, investment credit recapture tax, or payroll taxes, in which case the S-corporation must pay its taxes when they are reporting and filing employee withholdings. These items are usually reported, aggregated, and paid quarterly. Anyways, moving on. Thomas Drake's company has a net income from operations worth $175,000 and a corporate payroll that's worth $150,000. The corporation also has assets of $1.5 million, assumed to be equipment and not real estate property. Thomas Drake has a wife named Rebecca, and they married filing jointly. His wife has unrelated business income of $50,000, and their combined taxable income is $160,000, which is the value after the standard deduction or item as deductions has been calculated. Given this scenario, our team will base our analysis and conclusion based on these specifics. Well, here's Kaitlyn, and she will pick up where I left off and explain what is a 199A deduction and what is considered to be a qualified business income.
Thanks, Vincent. Hi, my name is Kaitlyn, and I'm here to address what is Section 199A deduction. Every year, individuals file taxes for income earned from the previous year. Each individual has their own filing status based on their specific circumstances. Depending on your filing status, you may qualify for specified tax deductions. For example, select business owners may qualify for the new Section 199A deduction. This includes sole proprietorships, partnerships, and S corporations. Enacted in December 2017, Section 199A also allows certain trusts and estates to reduce tax liability on income from a qualified trade or business. The Section 199A deduction has two components. First, the qualified business income component, and second, the real estate investment trust and publicly traded partnership component. This deduction, created by Tax Cuts and Jobs Act, allows non-corporate taxpayers to deduct up to 20% of their qualified business income, plus 20% of their qualified real estate investment trust dividends and qualified publicly traded partnership income. Mr. Drake, since your business entity is structured as an S corporation, you would be able to take advantage and qualify for Section 199A deduction. What is a qualified business income? What is included and what is not? As declared, Section 199A deduction has two components involved, with the first component being qualified business income. A qualified business income is the net amount of qualified items of income, gain, deduction, and loss from any qualified trade or business. The only items included in your taxable income would be counted. In addition, these items must be effectively connected with U.S. trade or business. Line items such as capital gains and losses, certain dividends, and interest income are excluded. W-2 income amounts received as reasonable compensation from an S corporation, amounts received as guaranteed payments from a partnership, as well as payments received by a partner for services under Section 707A, does not qualify as qualified business income. As stated, there are some items that would not qualify for the qualified business income deduction. In addition, these items are not properly includable in taxable income. Other examples of these items would be investment items such as wage income, amounts received as reasonable compensation from S corporation, and annuities, unless received in connection with a trade or business. Mr. Drake, in your case, you would be able to use the lesser of either your net income multiplied by 20% or your taxable income multiplied by 20% minus your net capital gain as your deduction. Now here's Kim to explain what is a specified service trade or business.
Thanks, Kaitlyn. Hello, I am Kim Haskins. I will deliberate on what qualifies under a specified service trade or business and address the exceptions under Section 162 in the IRS regulations. What is a qualified trade or business, also known as an SSTB? Mr. Drake, the following explanation provided clarifies and addresses any concerns regarding a qualified trade or business and what is allowable under Section 199A. As mentioned, Section 199A allows a deduction for qualified business income, also known as QBI, from sole proprietorship and relevant pass-through entities, also known as RPEs, and some trust and estates to deduct up to 20% of the combined qualified business income from qualifying trades or businesses. A qualified trade or business, according to Regulation Section 1.199A B14, means a trade or business that is a trade or business under Section 162 other than the trade or business of performing services as an employee. Section 199A regulations state that the IRS and Treasury decline to establish a bright line test for determining a trade or business for purposes of Section 199A. The reasoning behind it was the specified guidance is beyond the scope of the Section 199A regulations, but discusses two relevant considerations for filers derived from case law addressing trades or businesses under Section 162. This law states a taxpayer must enter into and carry on the activity at issue with a good faith intention to earn a profit, and the taxpayer must engage in the activity on a regular and continuous basis. Section 199A also states that a qualified trade or business is any included in Section 162 with three exceptions. The first exception is a trade or business that is conducted by a C corporation. The second is taxpayers with taxable income that exceeds the threshold amount. Specified service trades or businesses, which are trades or businesses that involve the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, broker services that are defined in Section 475C2, investing and investment management, trading as defined in Section C2, dealing in certain assets or any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners, including receiving fees, compensation, or other income endorsing products or services, licensing or receiving fees, compensation, or other income for the use of an individual's image, likeness, name, signature, voice, trademark, or any other symbols associated with the individual's identity, or receiving fees, compensation, or other income for appearing at an event or on a radio, television, or another media format. Lastly, trade or business of performing services as an employee. Aside from the SSTB exceptions, there are also income limitations and confines to the Section 199A deduction. I will explain the first three thresholds, while Kaylee will explain the wage limits after me. Limitations to income or otherwise on this deduction. There are three taxable income bounds and thresholds. The first threshold addresses a single person, estate, or trust with taxable income up to $157,000 and married couples filing joint returns with an income up to $315,000 with no W-2 wage limit. Individuals who meet this criterion are entitled regardless of the classification of the business or trade. After these limitations, eligibility is determined by phase-in and phase-out rules that may apply. The next threshold addresses taxpayers with a taxable income of $157,501 to $207,499 for a single person, an estate or trust, and married couples filing joint returns with a taxable income of $315,001 to $414,999. People in this criterion are phased out based on income and W-2 wage limit, phased in, and are eligible regardless of the types of business. The third limit examines single taxpayers, estate or trust with a taxable income of $217,500 or greater, and filers married filing jointly with a taxable income above $415,000.
Thanks, Kim. Hello, I'm Kaylee, and I'm here to explain further wage limitations. The IRS has identified a few types of service businesses that are not qualified, while all other businesses are entitled but are subject to W-2 wage limits. The thresholds do not apply to real estate, interest, trust, dividends, or publicly traded partnership income. W-2 wage limits are for taxable income that is greater than the lowest taxable income threshold, and the deduction for qualified income is limited based on wages. The result of this is that the owners of businesses that pay more in wages and invest more in intangible, depreciable property benefit the most from the deduction. When fully phased in, the W-2 is equal to the greater of 50% of shares of the business's W-2 wages, or 25% of W-2 wages plus 2.5% of the share of the unadjusted basis of qualified property. W-2 wages refer only to those wages that are allocable to its qualified business income, which includes contributions to certain Roth IRA and deferred compensation. It also includes the wages that the business pays using separate payroll organization. If the wages are more than business, they must be allocated proportionally based on the business's total wages. If there is an event of an acquisition or deposition in the business, the wages are allocated between predecessor and successor entities based on the relevant time period. A real estate and other tangible property that is used to produce qualified business income during the tax year is considered a qualifying property and is depreciable. The property must be owned as of the end of the tax year and it must not have reached its useful life. There are special anti-abuse rules for a property that has to be considered, as well as aggregation rules for combining businesses.
Thanks, Kim. Thanks, Kaylee. So, how does this apply to you and your business, Mr. Drake? Well, to simplify the answer, the qualified business income deduction can lower your tax liability. To recap, the QBI is the netted value of the trade's qualified income plus the gains minus the deductions and loss. Generally, this includes income from formalized entities like a sole proprietor, partnership, or just like yours, an S corporation. It also includes specific types of trusts, estates and trusts. Now, according to the IRS, what is not included in a QBI is items that are not allowed in your taxable income. Investment items, interest income that is not accurately assigned to your business, or income as a result of business abroad. It also does not include wage income, income losses or deductions from a notional principal contract. This is an example of this would be interest rate swaps between partnerships. You can also include annuities and annuities indirectly obtained by businesses, and or income from a reasonable compensation, income received as a reasonable compensation from an S corporation, or guaranteed payments from a partnership. Now, Mr. Drake, because you're a business owner who is regularly engaged in a business activity under Section 162, you are qualified for the Section 199A deduction. Since you are married, filing joint with your wife, your combined taxable income of 160 is not restricted to any confines. You fall within the first threshold, which addresses married couples filing joint returns with an income up to $315,000 with no wage limits. As mentioned, individuals within this criterion are entitled to the deduction, irrespective of the type of business or the trade, because your taxable income is below the lowest income threshold. To clarify, you don't need to be worried or concerned with the taxable income above this threshold level. The confines are for filers engaged in specific service, trade, or business who have a specified taxable income level. Your taxable income does not meet that criteria.
How do you calculate a 199A deduction? Mr. Drake, the calculation for the 199A deduction is based on a highly complex calculation that depends on several factors, which include the type of business and the owner's income. The following evidence provided walks you through the steps to calculate the Section 199A deduction. As stated, it is $170,000. This is normally included in your profit and loss declared on your Schedule C and your supplemental income from your Schedule E. If involved in farming activities, the profit or loss from farming on Schedule F. It is also reported on your Schedule K1 boxes 1, 2, and 3 for partnerships, as well as S corporation, or alternatively found in boxes 6, 7, 8 of the Schedule K1 for estates or specified trusts. The $170,000 is the result of your QBI minus your business deductions. These inferences are usually your SE health insurance, half of your SE taxes due, and qualified IRA contributions. After determining the QBI, we need to estimate your taxable income. As stated, it is $160,000. Your taxable income is all of your income minus capital gains on Schedule D and qualified dividends on Schedule B, as well as non-business deductions that determine your adjusted gross income. After determining both you must choose between the two values and must take the lesser to calculate your allowable 199A deduction. In your case, you take the $160,000, which is the lesser of the two values, and multiply it by 20%, which gives you your $32,000 for your 199A deduction. After determining your 199A deduction, you must multiply it by your marginal tax rate to arrive at your allowable deduction. For your reference, marginal tax rates have been provided below. Considering the info, we provided an estimation of your tax deduction has been calculated. Based on your marginal tax rate multiplied by the Section 199A deduction, the amount for allowable is $7,040. This is contingent that all data provided and assumptions made are correct.
Kaylee again. Contemplating our client's allowable deduction, we have gathered additional tax planning strategies that you can utilize and consider in the future. Tax planning, as stated, is an important part of maximizing deductions. There are multiple things to consider when trying to get the most out of a deduction. You can consider lowering your taxable income by increasing your capital gains. Capital gains are a large part of the 199A deduction as they determine eligibility, limits, and thresholds related to the deduction. If your capital gains are too high, it may impact the 199A deduction and is counterproductive to your plan. If you're above the income threshold because of capital gain, it is possible that you will be phased out. Since you have to consider taxable income when determining your 199A deduction, it may be best to lower your taxable income by making charitable contributions. Doing so may increase your deduction amount due to the lower taxable income. There is another way to go about lowering your taxable income, which is to consider prepaying qualified plan contributions. So that you're informed about these contributions, they will need to be made no later than the end of the year. Thinking ahead and deciding how much to contribute is an important part in order to increase your deduction and lower your tax liability. You can also plan to do something such as donate appreciated stocks or consider increasing your retirement contributions when thinking about tax planning strategies, and is another way to reduce taxable income.
Hey, Vince again. We're here on our last stretch and I'll be wrapping it up. So, to add to the planning strategies mentioned, an S corporation would also be able to use employee wage deferral strategies to lower your taxable income and to maximize the 199A deduction. Another way is to also buy more assets. Most assets that are placed in service by the end of the year are fully deductible. You can write off these associated purchases of an asset and it will reduce your taxable income. When purchasing assets, you can take advantage of the Section 179 and the 100% depreciation bonus that allows you to purchase high valued assets and expense the whole cost because of the high limitations. This planning strategy will reduce your taxable income greatly, which translates to a bigger refund and an increase in available cash flow. If you are over the taxable income threshold, you must make sure that the manufacturing operations are structured to fit the wage and asset test. So you could maximize your deduction. As mentioned repeatedly, if you are above the taxable income thresholds, lowering your taxable income may be the best way to take full advantage of the Section 199A discussion as discussed. Finally, there are a bit more complex strategies that are parallel to the tax plans mentioned. This would also include deferring income and accelerating your expenses to reduce it. You can also aggregate multiple businesses to improve qualified business income, wages, and an adjusted basis immediately after acquisition, or UBIA, to circumvent these limitations. If you have other businesses that are structured as a partnership or a sole proprietor, consider converting to an S corporation if you are able to maximize those deductions. As you can see, there are many considerations that can lower your tax liability. But of course, you must consider that this tax code is only a provision passed under the Tax Cut and Jobs Act. As we know, these provisions are only effective until 2025, unless further action is taken by the governing bodies. Regardless, these are still strong options for the near future and can benefit you and your situation. In closing, I want to thank you all for taking the time to listen. I hope you all enjoyed our presentation, and I'm fairly confident that this should have helped clarify any concerns regarding the Section 199A deduction. Listed here is our references used for our written and oral presentation. That being said, this being the last submission for the session, our team wants to wish you many blessings and stay safe. Furthermore, good luck with your future endeavors. I want to remind other students like us that Benjamin Franklin said, an investment in knowledge pays the best interest. So remember to continually learn, improve, and strengthen your foundation. Thank you for allowing us to share. Have a good day.